All right, so my next guest is a big part of the global market insight strategy team over at JPMorgan, and they just released their fourth quarter 2025 guide to market. So let's bring in JPMorgan Asset Management, America's chief market strategist, Gabriella Santos. And I love when you guys put this kind of stuff out. It's a lot of reading, so you narrowed it down at least for us for maybe the 5 critical things that viewers and investors should be thinking about. Let's talk about that. So leaders, essentially leaders of today aren't necessarily going to be leaders of tomorrow. Is this sort of a cautionary tale here?
That's right. It's honestly a tale that technological evolution happens over time. You get these early winners from it, but it's a feature for it to change, not a bug. So here we've got near record concentration, nearly 40% made up of just 10 companies. Right. A lot of it related to the AI theme, but take a look. Actually, 6 of them were not on the top 10 years ago. Only 3 of them were there 10 years ago, and only 1 was there 20 years ago. So these things change. The AI theme is real. There are early winners, but this will change over time, and we got to change portfolios.
You know what I like about this too? That means that, you know, when we look at this in 10 years from now, there'll be names on here that we don't even talk about at all now.
That's right. Haven't even been created yet.
I like that. I like that. Okay, so let's talk about the other part here. Artificial intelligence. This obviously is the theme, though. For now, though, you say this is not stopping right now. This is nothing stopping this train at this very moment.
Not at the moment, especially on the left-hand side. All of this investment that's happening to build out the digital and physical infrastructure for large language models, nearly $350 billion just this year. And this is having, on the right-hand side, real economic impacts. You can see a lot of investment, industrial production in these tech areas where you're seeing stagnation anywhere else.
So can these are also, you know, listen, we talk computer equipment, communications equipment, semiconductors, but these represent companies, right? And these are
That's right.
I mean, you think of an Oracle. Oracle was sort of dead in the water, and all of a sudden, you know, it's skyrocketing. They've retooled themselves to be a part of this story.
That's right. Every company has to adapt to either be one of the beneficiaries of the investment or to be companies that are adopting AI for inefficiencies or to generate revenue.
All right, Federal Reserve, the steeper the cut, the shape of the yield curve. Walk the audience through, you know, the significance of this, you know, and of course, ultimately what it means for their portfolio.
That's right. And as the Fed cuts rates, we should continue to expect that our cash-like instruments will continue to see yields fall from a 4 handle to a 3 handle by the end of next year. That doesn't mean the curve as a whole comes down in equal fashion. Actually, what we're expecting here in dark blue is a steepening of the curve.
Really?
Ultra short end comes down. The 10-year stays anchored around 4%. And look, that's the normal shape of the curve. Where we are right now is weird, and we're just normalizing that.
So let's talk about what it means, market returns, because that's what we're all kind of working for here. Yeah. You know, this is, you guys have done a lot of work on this. Essentially, this rally, yes. In a nutshell, do you feel like it continues, and if so, for how long?
Yes, for both stocks and bonds. You can tell in the previous rate cutting cycles we've had, if there's no recession, both tend to do well over time. The trick is each rate cutting cycle is unique. For bonds, beware of some of that duration. We like short duration that we just talked about. And for equities, keep valuations and concentration in mind.
And again, this is the first rate cut.
That's
the times it doesn't work is when there's a recession. If we could avoid a recession, for the most part, history tells us this market could be up and
to the right.
From here.
That's right.
And finally, you like international still, right? You like international to continue to outperform. We will note that it's been for 20 years, the chart is relatively ugly.
Yes.
So you're saying that it still has a lot of room to the upside.
That's right. Take a look. The last 15 years, it's really been international underperformance versus the U.S. We've had the biggest outperformance this year since 2009, but you can't really see it in the chart.
Right.
So we think this is just the start. Something like the 2000s, where you had a period of dollar weakness and international outperformance.
Interesting, though. These all happen in gray areas, recessionary areas.
That's periods of declining dollar.
Oh, is it? Okay, so the dollar was going down.
That's right.
In these periods. Okay.
That's right. That's right.
This administration wants the dollar lower. I'm not sure how much lower, you know, but do you think it can go lower from here?
We do think so. It's been a lot in 1 year, 10% weakness. Right. That's the biggest at this point since the early 1970s. So we shouldn't expect that pace. But normally, once it starts, it keeps going for a few years.
I got you. Great work. Thank you
so much for featuring it.
Thank you.
Thanks so much.
Absolutely. Thanks a lot, Gabriella.